Are you an investor looking for premium market opportunities? Presenting premium and exclusive service for investors by Kalkine.
Self-managed super funds, or SMSFs, are extremely popular among Australians preparing for their retirement. An SMSF provides you the flexibility to manage your investments according to your own choices. Plus, the fund allows you to park your money in a variety of assets, including listed shares, properties, both residential and commercial, and even regular term deposits with banks. Considering that these funds are so popular, understanding how tax on income is calculated is of critical importance. Today, let's quickly learn what the Australian Taxation Office, or ATO, has to say about SMSF taxes. The ATO clearly states that a concessional tax rate of 15% is levied on SMSF income. The condition is that the fund should be a complying fund with respect to SMSF rules. If this condition is not met, the income tax levy can be as much as the highest marginal tax rate. SMSF income comprises net capital gains. For example, income accrued when an asset like a listed stock is sold at a profit, interest income, dividend income, and also rent income. Since the levy on SMSF income is on the lower side compared with what it would be if the income accrued directly to an individual, SMSFs are considered a prudent choice. Fund trustees should also be aware of what the term assessable contributions signifies. These contributions are also taxed at the concessional 15% rate, and they include employer contributions and personal contributions by members that are intended to be claimed as a tax deduction. Another very crucial aspect is tax exemptions during the retirement phase. After all, an SMSF is a tool to achieve a better retirement. A fund paying a pension to members can definitely have further tax concessions. Here, the term exempt current pension income, or ECPI, is of extreme significance. It means the investment income that a pension-paying fund receives, and if such an income provides a pension stream, the investment asset is tax exempt. Any SMSF must always ensure that all of its transactions are on an arm's length basis. The ATO very specifically outlines that in the event of a non-arm's length income, also called a NALI, the highest marginal tax rate would be levied. The term NALI is defined expressly by the ATO, and trustees must take a note of it to avoid any lapses. Lastly, you should also know what can be deducted from the assessable income of the fund. Indeed, losses or outgoings incurred during the process of producing SMSF income are deductible. While this was a brief account of how taxes and deductions work in SMSFs, there could be many more complex aspects that might require deep understanding. For this, fund trustees can rely on SMSF expert advisors.